Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, November 15th. We got a lot of data to go over today, so we're just going to delve right into it. And we'll start off with the Consumer Price Index, also known as the CPI, for the month of October. So this is inflationary numbers for the consumer level, so it's an important index. But the Fed's favorite gauge is what they call the PCE, or the Personal Consumption Expenditure. But they do look at this one as well. So September we had a pretty hot number at 0.5% due to the high spike in oil. And for the forecast for October, it dipped. It was supposed to dip to 0.1. It came in expectations. Now, when you strip out the food and energy, we get what they call the core, and this is really what the Fed will work with, or what they'll look at. So in September, we had a 0.1% increase. And in October, we were forecasted for 0.2, and it came again right at expectations. So year over year, this brings us to about 1.8%. The Fed would kind of like to look at this at around the 2.5% range, and the PCE at the 2% range. But the PCE's also dipped quite a bit, all the way down to 1.3%. So we're kind of at a standstill with inflation. Where inflation, with these rate hikes, I'm not sure how they can expect it to go up. So it'll be interesting to see if inflation will ever go up with the rate hikes, especially next week or next month. We're supposed to have the Fed funds, or the Fed funds future basically is pricing in a 100% rate hike in December. And then next year we're projected to have another three rate hikes next year as well. Let's kind of move on with this. We got the retail sales for the month of October. So in September we had a 1.9% increase. We got a lot of back to school sales going on back then. It was supposed to be basically nothing in October, and it came in at 0.2%, so a little bit better. Retail sales, when you take out the big ticket items, autos, that was a pretty good one at 1.2%. Forecast was supposed to be 0.2, and it came a little disappointing at 0.1%. So now we're going into the fourth quarter, or we're in the fourth quarter. We got, November. We'll have to wait and see if we get how Black Friday does, and of course December with the holidays. Typically, we will see a little bit of a spike here, and they're kind of projecting we could have a good holiday season here with the economy moving forward. People might be more likely to spend, and so I think that's what they're kind of forecasting. Again, we'll have to kind of wait and see. Last but not least, we got the Empire State Index for the month of November. This is manufacturing in the New York region. So it had a pretty hot number back in October at 30.2, and it dipped down to 19.4. Still a good number, but it obviously a drop from the month before. Currently, headline news: stock market is down. Dow is down quite a bit. It's actually down over 100 points so far. Again, part of it is tax reform, which has been going on, but now a new wrinkle got brought in. Then we got a few Republican senators that would be good to go ahead and tie in a repeal of the Obamacare to the tax reform. So you kind of have to you can't do one without the other, which again, this is going to delay the process further and may result in nothing getting done. So this is kind of concerning investors as more today. And of course, they're doing some profit taking as we go along. And last but not least, we got lower oil prices as we're finding that the U.S. had a higher stockpile than they originally thought. The supply was a little bit more, and plus we're finding that the IEA came in and basically stated that demand's not quite there yet, so there's not a lot of demand. So that's why you're seeing a little bit more supply than versus the demand. So stock prices come down. Oil prices have come down a little bit. We're down to about 55 and change, where we at one point had reached between $57 and $58 a barrel. So let's go take a look, see how this affected the bond market. Bond market was up quite a bit today, as we were even down a bit. But right now we're fighting up against pretty much a triple layer here. We got the 200-day moving average, we got the 25-day moving average, and we also got this other line of resistance here. So we got three layers here that we're fighting against, and at one point we were above it, but since we pulled back and just below the 200-day moving average. So currently we're up about 9 basis points, but most likely most lenders have came in with a little better pricing today because it was higher at one point, but since later, this is kind of later in the morning, it's pulled back a little bit. We're at one point about, at least good 14 points higher, or about 14 points. Now we're down about we're up about 9 basis points. So down about 5 so far for the morning here. Again, so I would say we do got a little bit better pricing today, but I would kind of watch that. Again, this could be a tough layer here to get over as we're kind of seeing this. We would have to really kind of see stocks take more of a tumble for us to be able to break it. Now that is possible, because if you look here at the Treasury, We are above the 225-day moving average, as we had mentioned. I'm sorry, we're down below the 25-day moving average, and the next level is here at the 200-day moving average. So we do got some space here to drop and get that improvement here. So that might be a possibility here. But again, just be on the alert, not sit idle, because that could quickly change. All right, so again, a little bit better pricing today, and that pretty much wraps us up. If you guys want to get more data throughout the day, just come over to Twitter. You can find me at Mike Bjork on Twitter, and get more data there as well. I hope you guys have a good rest of your day. Thanks for watching, and we'll see you guys tomorrow.